Okay, so tonight we are pleased to have our final session, which is Where's the Money? And with us tonight is Scott McCoy with Mount Rogers Planning District. We have Jeremy Repass with People Incorporated. Mike Ratliff is the president of First Community Bank. And Ernie Maddy is with Virginia Community Capital. These guys probably know where all the money is and how to tell you to find it. So without further ado, I'll let you guys decide who's going to start first.
Would it help you all for everybody to go around the room and introduce themselves and tell you what kind of project they're doing?
Yeah, I think that'd be great.
Yeah.
How about our outfitters on the end? You want to start?
Yeah. My name is Justin Harris, and this is my wife Brittany, and we are expanding business called White Blaze Outdoors. We're located here in town, and we are offering interpretive guided hiking and biking tours all around the region.
I'm Pauline Wilson. I have Pauline's Place, a hair salon out on Main Street in Avenue across from Dairy Queen, and I'm an existing business, and I'm here to learn and pull some knowledge from you for my business to succeed a little bit more.
My name is Shane Grosclose. I've got a startup business called Greendale Turf Solutions. It's a turf management and lawn service business here in Athens.
My name is Frank Cardinelli. I own a small business called the Resale Shop, where we repair and sell small electronics.
I'm out necessary. My wife's not here because I ain't got no money. She won't go out in public with me when I ain't got no money. But anyway, I own Sargent's Pay Lake and Campground, existing business, and been in business since our 4th year. So we're here to learn more and try to get some more money.
My name is Kevin Blazer. This is my wife Jody, and we're in the process of starting up a senior transportation service. It's going to be called Honeysuckle Assist.
My name is Mac Owens. My partner Grayson is out of town on work, and we are in the process of beginning a non-emergency medical transportation.
My name is Hannah Eichen, and I'm opening up a fine arts and crafts retail store in Abingdon, and I'll be teaching some classes in there as well.
My name is Allison Morris, and I am offering some assistance to the community by opening a daycare with intake. I'm Jennifer Chumley. I will be starting a business, basically just myself, selling plants, herbs, like at the farmer's market.
My name is Amy Smith, and this is my husband Jared, and we just opened Solstice Nutrition here in the Small Business Incubator on the 1st of the year, and we provide nutrition consultation and education, as well as cooking classes, workshops, and hopefully soon some farmers market tours and grocery store tours, things like that.
Saw your flyer on the wall.
Oh, great.
I'm Jenny Carlisle. I am opening Crafts on Main this Saturday, so everyone come please. Sewing and craft supplies and classes for both adult and youth.
I'm Hunter Danhart, a local business owner. My business partner's right here tonight, but we are opening a Mercantile on Main Street.
So to each one of you want to state who you represent, what you all do, what kind of programs, and then we'll open it up for questions.
Sure. Again, I'm Ernie Maddy. I'm the commercial real estate loan officer for Virginia Community Capital. Virginia Community Capital is a little different setup for a bank than you're probably normal or comfortable with, or used to, I guess is a better word. We're a for-profit bank, but we're actually owned by a nonprofit. We're the only one set up like that in Virginia. There's only about 10 of us around the nation set up like that. We were formed about 13 years ago by 4 different state agencies to provide community banking services throughout the entire Commonwealth. We have the nonprofit does technical assistance, trainings, like Sandy's with us, and we do things like this. Then on the for-profit side, we have a small business lender, which is Cindy Snyder. We're an SBA preferred lender. So we do a lot of business acquisition loans. We do a lot of expansion, second locations, where we're able to use the SBA guarantees on the small business side. And then we lend to localities and government agencies as well. Then on the commercial real estate side, which I handle, we do mixed-use properties, we do commercial properties, multifamily properties, single-family investment properties. We do a lot of historic tax credit projects. If you're working on a building that's going to earn the tax credits, we will bridge those. So you can actually use the credits during the course of construction. And we also do a lot of affordable housing, workforce housing, and low-income housing tax credit projects as well.
I'm Mike Ratliff. I'm the market president for Southwest Virginia and Eastern Tennessee for First Community Bank. Many of you may have heard of First Community Bank here recently, as we just partnered with Highlands Union Bank. Some of you may be current customers now, and want to welcome you. But we're a 59 branch bank. We have branches in 4 states: Virginia, North Carolina, West Virginia, and Tennessee. And we here in Abingdon, we have 5 branches here in Abingdon. Marion, Glade, Wytheville, all the way up into the New River Valley, Roanoke, and then all the way out to Knoxville toward Tennessee. So a big network there. From a lending standpoint, being a larger bank, we have ability to do the smallest business loan you can think of up to one of the larger business loans you can think of. We have programs for both small businesses. We have a type of program for startup type businesses. Which is more based on your personal credit to allow you to get started. And we go up to, for current existing businesses, we have a great small business program that allows you to kind of capitalize on what you've done thus far and move forward and grow your business. As far as the bank itself, we're full service bank, just as any other bank would be, in services that we offer, from checking accounts to credit cards. We, as a bank, we do hold our own credit cards. So if you get a credit card with First Community Bank, it's actually a First Community Bank card. So you pick up the phone and call the bank to talk about it. We have, again, business loans. We have mortgage lending. Pretty much, every product and service in the financial industry.
I'm Jeremy Repass. I'm a senior business lender with People Incorporated here in Abingdon, Virginia. A lot of people know People Inc. for different services that we offer, from the Virginia Cares program to housing, daycare, those kind of things. I work in the Economic Development Department. And what we do as far as on the business lending side is we help individuals, like Mr. Ratliff was just talking, primarily with startup. We do service existing businesses as well, but we're kind of that bridge to kind of help you get from point A, which is the startup standpoint, up to the banking standards. We don't try to compete with banks or anything like that. If there's situations that a bank can't do alone, which typically we require that you've already been to a bank and been denied their services for whatever reason, we have mitigating factors. We don't have set credit scores, those kind of things. We can mitigate, if it's well collateralized, we can deal with any credit issues that we may need to overcome. Or vice versa. If it's a little under collateralized that seems appealing to a traditional lender, we try to mitigate your credit and still get you into a business loan so you can reap the rewards of those tax deductions and those kind of things. Right now, we have business loans that are at 7.5%. If it's a tourism-based business and funding is available through the 9th District Development Financing Program, we can get you as low as 3.5% on a tourism loan. Funding right now seems to be there for a while. We had an astronomical amount of money that wasn't lent out, but with tourism-related businesses, when those come in, those applications come in, you're not talking about your $4,000 or $5,000 loans. You're talking $50,000 upwards of $300,000, $400,000. So that money can get gone really quick. So if you're in the tourism business, you might want to inquire on that and kind of keep your name in the hat, if you will, to try to capitalize on that low interest rate. We also have in the economic development. We also have a thing that we're doing right now for taxes, which is the VITA service, the Volunteer Income Tax Assistance Program, to where folks can come with an income of about $50,000, $55,000 or less, and get your taxes done for free to try to help, with those fees and those kind of things. We also have a lady, Evelyn Taylor, that does some consumer lending that can help with those expenses to try to help you overcome certain obstacles in life, to try to improve your life stance as far as improvements to your homes, vehicles, those kind of things as well. So, so if you're looking to open up a business or you're, trying to expand and you don't qualify for traditional lending, please stop by and see me and let me see what we can do for you.
I'm Scott McCoy. I'm with Mount Rogers PDC. I'm the loan funds administrator. Similar to People Inc., we're a secondary lender. We do secondary lending for the Mount Rogers region, which is Washington County up to Bland County and out to Carroll County. We have loans generally anywhere from $5,000 to $150,000. Our loans are in real estate, equipment, inventory, and working capital. If you have any questions, let me know.
What questions do you all have? We can sit up here and talk about all the products and services we offer, but you guys need to know what you need for your business.
I'm gonna ask a question. I'm the director with the Small Business Development Center that serves this area. So the question I hear from them a lot that may help them is that they need to know what you all are looking for in collateral from them when they're trying to get a loan, and what kinds of things you would accept as collateral.
From a People Inc. standpoint, to put it in layman's terms, we want to see skin with us, and usually across the board, we want to see skin in the game. So some things that may not seem worth a lot to some individuals, if we see that you're putting a whole lot of what you own into the project, that I think that stands for a lot. So with us, such as personal automobiles, real estate, equipment and inventory, we can use those kind of things, but when you're dealing with inventory, keep in mind that that's a rolling inventory. What's collateral today? If you do a blanket lien through or UCC on something, what's collateral today isn't necessarily going to be collateral tomorrow. So it's really hard to put a dollar amount of value on things such as inventory and equipment. Equipment depreciates and those kind of things. So with us, it's, when we see personal assets involved along with business assets, that really seems appealing to us because it's the same as cash injection with us to put in it.
Yeah, and then any of your other normal types of collateral, obviously real estate, if you're buying the building, we can lend up to around 85 or 90% if it'll qualify for the SBA guarantee. The same with there's some different guarantees there we can do on the equipment. Inventory normally not, again, because like he said, it kind of goes out the door there. So, and we're always looking for you to have like cash into it. Even if it is going to be the SBA guarantee, they won't guarantee up to 100%. So normally you're going to need somewhere around 10%, 10 to 15% of something. If it's, again, the cash is always great, but a lot of people don't have that much, cash on hand, so you can look at those other items.
So,
Sorry, I didn't mean to interrupt. What was the range of the SBA guarantee? 50 to 70, something like that?
No, it'll guarantee somewhere between 80 and 90, really, 85 to 90. Again, it may not be of the total project. If you're buying a certain piece of equipment, they can guarantee up to a certain amount on it. It all depends on what the actual collateral is, on how high that guarantee will go.
Sorry.
that's okay. So at First Community Bank, we have a kind of a small business program up to about $125,000, and basically we don't look. It's great for startups, even great for existing businesses. We don't necessarily look at your cash flow, your business as closely. We're looking at your personal credit score as you're guaranteeing that loan for your business, and we also look for collateral, as the question was. The collateral that we look for in that, again, real estate. We like equipment. If you're an existing business and you make a product and you have raw material inventory and you sell that product and you issue an invoice for that product and you have a receivable, we also do what's called ABL lending, which is asset-based lending, meaning that basically you would have receivables and inventory would be your collateral of your loan, and each month to the bank you would basically provide your monthly financial statement, a balance sheet and an income statement, and you would provide an AR aging report, an inventory aging report, and you would also provide what we call a borrowing-based certificate, which ultimately summarizes all those other documents and says, all right, I've got $100,000 in, for easy math, $100,000 of receivables, and we give you a lending credit of up to 80% of that. So you would get $80,000 of availability on your line of credit for that. And then if say you had $100,000 of inventory, and we usually do 40 to 50% of inventory, so you'd get another $40,000 of that. So we'll set a line of credit amount of maybe $150,000, and in that scenario, you would have about $140,000 available to you on your line of credit to use, and that, of course, could change each month as your receivables go up and down, but it follows the need of your business with the way it fluctuates.
So with the Mount Rogers PDC revolving loan fund program, loans secured with equipment can have terms of 5 years, and then loans secured with real estate are up to 10 years. So.
One thing that was key that Mike mentioned there is about the personal guarantee. If you're going to get a business loan now, you're going to have to personally guarantee it. Our guidelines are anybody that owns more than 20% of that business has to sign a personal guarantee on it. So if you're with if it's split 50-50, both of you would have to guarantee it. Now we've had it where there's maybe 5 or 6 owners and only one person had more than 20%. That's fine, but sometimes that one person wants the other ones to go ahead and guarantee. We'll take as many guarantees, but anybody over 20% is required to sign a personal guarantee, which means if the business goes under, you're still personally responsible for that debt.
And that's real important too with what Ernie had just said too, kind of piggybacking on that. It's real important that when you set up your business entity, whether it be an LLC, an incorporation, or whatever, to make sure that you, not only with your articles of organization, but you file an operating agreement as well. That identifies who owns the business, what portion of the business they own, who has the duties of, take an LLC for instance, you can have 5 different members, but only 2 of those be authorized to sign for loans on behalf of the business. As a lender, we need to see those kind of things so that we know we have the right parties signing for the right things. So I know that's a little bit off subject from how you get the money and so forth, but that's something that particularly at People Inc. that I'm going to be looking for when you come and apply that operating agreement and the articles of organization as well.
So one thing I forgot to mention was equipment. I heard maybe the 2 of you all that you're doing like a fleet type service. So actually today I closed a loan for a similar type company that provides medical services, and they needed vehicles. So basically we did a $120,000 loan. We finance fleet vehicles 100%, and we'll do them up to 5 to 7 years depending on kind of this type of vehicle, age of the vehicle, and things like that. And that also goes for equipment as well. We'll finance up to 100% on equipment, and we'll finance that out to up to 7 years. So that, and again, in that $125,000 and less range, that is solely focused on your personal credit strength. If your personal credit strength may not be as good, then that kind of goes back to where we need to look at, the strength of your business. If you've been in business, sometimes that's tough if you're a startup, and that's when we kind of hand things off to people incorporated that, we just can't find a way to get that done. But, in the sense that your personal credit is decent, and I think right now, I think we're 620 and up is we have a way to get that done for a credit score of 620 and higher. And we have, we have some different options there as far as terms and trying to find a payment that works for you along that you can afford to pay back with your current business.
What qualifies as the ecotourism, I think, was it you that said there was a tourism?
Yeah, the 9th District Development Financing?
Yes.
Yeah, that was started up back when Congressman Rick Boucher was in office, that's strictly based around tourism. You were asking what qualifies someone?
Yeah, what would qualify as that? I know these guys over here with the bicycle.
Yeah,
But what else would fall within that?
when we get to the underwriting process for loans that apply for that tourism loan fund, there's actually a screening committee that goes to, and they kind of determine whether or not the business would fall under the realms of tourism. To kind of put it, if I got to being put on the spot and having to name someone is tough, but are a type of business, I would put it in anything that would draw individuals to the area. Things like, I mean, they do campgrounds and things of that nature, because if you take like the Back of the Dragon and so forth, or the Spearhead Trails and those kind of things, they've been doing like cabins and campgrounds and those kind of things. But if someone was to want to put, say, a hotel here in Abingdon, and they said, well, Abingdon is a tourism-based town, so we want to put a hotel here, that really wouldn't qualify under the tourism aspect of it, because it's not drawing individuals to the area. You're just piggybacking off of something that would draw them something to the area. So they've kind of gotten away from that. We've just recently, in the past few years, started doing like breweries. And that was a tough hill to overcome, because I had to prove that the brew trail was an existing thing. You know, I guess where it's new and we're getting so many breweries brought into the area, particularly that in downtown Bristol and so forth, it was tough getting the committee members that are away from here that represent different counties to see that, hey, there's a trail that people get on and they go to these different breweries and try. You know, I'm not an alcohol person, but apparently, you know, it's a big thing. So it really is one of those things that, you know, if you bring to my office and we sit down and talk about it, if I feel it could really qualify for that, then we would take it to probably, you know, someone on the board and say, hey, do you think this is worth presenting, and try to go from there. Did you have a particular business in mind, or?
No, I was just curious, because I know sometimes those things, they will envelop a whole, you might call it tourism, but it might envelop a whole group of
Right.
things, and I just wondered what fell in that group.
Right.
So
And
really it's individual basis.
Yeah, and it's ever so changing. Like I said, the breweries wasn't a part of it, now they are.
Okay.
Restaurants, some restaurants are just there to capitalize on the tourism-based, economy, but then you may have a particular restaurant that has a unique style that would actually bring people in. So if it's a business that can actually draw people, chances are it'll qualify to be looked at. Yeah. Something like Justin is doing, that would be something that if someone is looking for biking in this area, that would actually draw someone to this place, so.
Yeah, one of the things that comes up, I've done a few of these, is what information do I need to bring into the bank, to do this? Typically that's, 2 to 3 years of personal tax returns, 2 to 3 years of business tax returns if you're an existing business. You may not have a separate business tax return. It may be a Schedule C on your personal tax return. So your personal tax return would encompass all of that. W-2s are important to bring in. I would think if you haven't, I would encourage you to go ahead and start filling out a personal financial statement. That's a good practice to get into, because that's going to be something that's required at every bank, I would believe, to basically just outline your assets, liabilities, and debts. So that, because that's one of the key focal points, especially if you're a small startup business, is we're focusing on you personally to kind of get you the funding you need to get your business started. Any other things I've left out?
Well, your business plan that you guys are working on now, and know what's in that plan. I've seen people come in before and they've got a fantastic business plan. It's 100 pages, and they've went and paid somebody $5,000 to do the business plan. They've got no idea what's in it. They probably hadn't even read the business plan yet. So know your business plan, know your numbers, know where you came up with those numbers. If you're doing 3 years of projections and you've got, I'm gonna make $120,000 this year, $10,000 every month. I'm gonna increase it by 5% next year, and it's the exact same every month. We know you haven't put the time into it. Tell us where you've come up with those numbers, why you think you can do this. Tell us if there's a certain season you're going to have better numbers. Tell us if there's going to be a downtime. If you got 3 months out of the year where you don't have a whole lot of business, how are you going to keep the business open? How are you going to pay your bills? How are you going to pay us back? So you make sure you have all those items in there. Know your credit report. We are going to pull your credit report. So if you know there's an issue on it and you're working on it up front, tell us. Just know what's in there so there's no surprise. If we get, that's normally going to be one of the first things we do is pull that credit. So if you know there's some issues in that, you can already be working on that before you ever go in. And have an amount you need. Don't walk in and say, I'll take whatever you can give me. Because 100 out of 100 times, that's going to be zero then. Because that means you have no clue how much you need. You have no clue what you're going to do with what we're giving you. I've seen people come in and have it down to the penny on equipment and inventory and working capital and exactly what they needed. We're more apt to lend to somebody that's put the time into it and knows what they need, and we know what our money's going to go for other than just, I'll take whatever you can give me.
A lot of people end up starting a business when they no longer have a job. What would you suggest to people who are in that kind of situation? Because I know it's hard to get a loan when you don't have an income.
With me, are you talking about someone that decided to remove themselves from?
Yeah.
Okay. In that case, would be to make sure that your personal finances are in line. We wouldn't want to see someone just pulling himself out of I personally wouldn't want to see someone pull themselves out of the workforce with a whole lot of personal debt and be solely relying upon the business income because you're just starting up. So I would say for someone that wants to be removed from the working world for a little while to get things in line would be to align your personal finances to accommodate that. With us, getting a business loan without a job isn't impossible. It happens. Seeing that secondary source of income that may continue is a good thing, but it's not always required. But the best advice I could give would be to align your personal finances for that.
Or have someone sign with you
Yeah.
that is working, or where if they're guaranteeing it with you, that's kind of that secondary source of repayment that he's mentioned.
And that could be like a husband.
Mhm.
Yeah.
Or parents, or brother, or sister. Normally, our bank likes it to be somebody you're related to, not your buddy. Because buddies walk away from your debt, but and you're not buddies anymore. But
Sometimes family do
that's
that.
it. We've seen that too. Yeah.
We've tried to develop a thing where if it's $10,000 or less, and someone is, say the business is kind of a side thing, or say between the applicants, there's personal income outside of the business. If it's $10,000 or less, we tend to focus on it's a business loan, but we look at from the personal aspects of it, of does your debt to income qualify as if this was a personal loan? Would you still be in that debt to income ratio even with the business loan? Because if that's the case and you start up business and say your business plan, say you were way off, because when you're a startup business and you're doing your business plan, you're going to base it off of the facts that you have, but those facts may not be relevant so much to this area. You may have to use information from outside sources and those kind of things. So in that case, it's like putting numbers on a wall and just closing your eyes and throwing darts and just having to put that down on paper. And we understand that. So what we try to do is base it from a personal standpoint and a personal income and to debt ratio, and try to get you in a small business loan to where you're not getting in an astronomical amount of debt that your personal income could still sustain. So we do have that. It's not, I wouldn't call it a different program, but it's kind of a different qualification tier, if you will. So. Y'all got to have more questions.
I've been in business, this will be my 4th year. I've got the campground, and I haven't asked because I haven't found it yet. Because I've been trying to find land to expand with. Of course, the immediate area, no one's selling, no one's wanting to lease. People are tied up in the mountain with their family properties and stuff, which I understand. But is your rate different on if if you're buying land to expand versus starting up. I know somebody mentioned tourism. If it's tourism related, 3.5%.
Mhm.
But you key more to existing or startup business more than existing.
No, we can do existing too. The one thing that the 9th District Development Financing frowns down on, I guess you could say, is refinancing old debt. They don't like taking on new debt. But even if it's an existing business and you're looking at expanding, by all means, come and talk to us and let us talk about that. You know, because that tourism money was set aside specifically for businesses like you. So definitely, you know, get with me and let's talk about what you've got going on.
Well, I haven't found nothing yet. I've been looking.
I got some oceanfront property in
As much rain as we've had.
It's near the well fields, but you know, it's about as close to the ocean as you can get. And that committee too, they really tend. The 9th District is based more around you have to be up to bank standards in order to qualify for it. They look for, you know, a pretty nice looking credit report. Real estate secured is a plus with them. We have done non-real estate secured loans, but most of your tourism based stuff with that interest rate, it's almost going, they tend to go towards real estate secured.
You know, at your typical bank, you're going to see what's more of risk-based pricing, not necessarily a set rate for this or a set rate for that. It's going to be based on, you know, your personal credit history. It's going to be based on what kind of collateral. It's going to be based on what our loan to value of that collateral is. It's going to be based on, you know, your past credit history. It's going to be, you know, so a lot of factors kind of go into what that rate is. As you know, this may bring the rate up a little bit, and you may have great credit, and this may bring it down, and you have good collateral, and we were at a 50% loan to value or something like that. So that all factors into what your final rate looks like. So tough to, you know, kind of pinpoint and say it would be this rate.
Right. I was just
Sure. No. Yeah.
clarify, you know, that I do know that every bank's got just a little bit difference on every loan that they have. Although I keep hearing land is collateral, but some people aren't just going to come up and buy a storefront, or that most new businesses start out leasing. But some do buy. But I know when they buy a building, that rate may be different than just buying a piece of property just to extend your campground or something like that. You're going to get a different rate because you're buying land, you're not buying a house or anything like that, or a car. I mean, all those rates are different. I
Right.
understand that. Yeah.
Obviously, if it's real estate secured, there's less risk. And like you said, risk-based than it is on a vehicle or
Right.
equipment or inventory or things like that. And your real estate doesn't lose its value as fast as all those other items.
Right. They don't
Hopefully it
make
doesn't
land
lose its
anymore.
value. That's not making any more.
Making that wall back.
And with People Inc., the risk base doesn't necessarily come into play. You may be, you know, if you've got good credit and those kind of things, you're going to be able to go to Mike and Ernie and some folks and traditional lenders and get a lower rate. If everything's where it needs to be in line to qualify for that lower rate. With us, the way we don't necessarily have our own money to lend. We apply for money from the Small Business Administration, the U.S. Treasury, and we'll borrow money at a lower interest rate from different banks and so forth to re-lend to the community. But when we apply for these funds with the different entities, we set aside or give them a description of the guidelines that we're going to fall under. So what we do is we set our interest rate, and we may say interest rate will be 4% over prime. That's kind of where we're based at, is like 4% over prime, but prime's kind of going back and forth so much that it would be so tough to keep up with where we need to be.
Right.
So right now we set it at 7.5% and just leave it there. So if you've got really good mitigating factors and you would qualify for a bank loan, you're probably going to get a better rate through a bank, you know, if you fall under those things.
Is there any veterans preferences with any of your loans?
I'm sorry.
Are there any veterans preferences or programs with any of your?
There used to be, and one of the qualifications in order to qualify for funding from the U.S. Treasury Department was that you had to be a minority-owned business, 51% female-owned business, or a veteran, those kind of things. Right now, there's so many qualifications with U.S. Treasury. We don't deal too much with Treasury funds, right now, but there's so many qualifications that it's almost hard not to qualify for those treasury funds that we get. But being a veteran is one of those things that would qualify someone to borrow money from the U.S. Treasury.
Can you explain the process as far as trying to get a commercial property? If I wanted a small commercial property, what process would I go through to maybe secure one?
First, obviously, you find your property. Hopefully, you've already got a business plan, and then you'll build. You're always adding and subtracting from that business plan. So you're going to add, I guess, that new phase of it that you're buying a property. And then we're qualifying it, we're going to decide if we can do 10% down, 20% down, 25%, depending on obviously what type of business it is, how long you've been in business, your personal credit history with the guarantees and things like that. And if it qualifies for our SBA guarantee program, then that's another level of it there. One good thing about our SBA lending program is we're what's called a preferred lender through SBA. So they trust us to make all the decisions on the loan, and then we just have to send it to them after it's already closed and funded. It normally saves you probably 45, 60 days in the approval process. Then we don't have to send it to SBA to get an approval prior to doing the closing. But
I mean, is it like a home loan where they look at your, they look at all your monetary things that you have?
Yeah, that'll be on the personal financial statement that he was mentioning. We're going to look at that first, because what we want to do is look and see what's the first avenue you're going to make the payments on. How are you going to make that payment back? If that's not working, what's your second one? And then if that's not working, how do we get out of it? What can we sell our collateral for? What, if we can't sell it for what's owed on it, what do you have to make up the difference, or can you make payments on that difference? So yeah, it all goes into that, since you're having to personally guarantee it.
So is there like a debt to income ratio?
We normally look at what the 1.2, so it means you've got, after we take out all your expenses and all your debt, you've got 20% above what that is and we take out living expenses and all those items when we're figuring the debt ratio. And we are a debt service lender, so you got to be anything below 1.2 is probably not going to work with us.
So ultimately, the 1.2 is, kind of think of it, for every dollar of debt you have $1.20 of income coming in.
Okay.
Yeah. But I would say, we have the program of $125,000 if your building is less than $125,000. So it's real estate secured. We'll finance. We focus more on your personal credit history and your ability to repay and how you've repaid other loans you've had. And we look at that, and then we will do up to 85% of that property, of the purchase price. So if you buy it for $100,000, we'll give you $85,000. So you got to come up with 15% of that purchase price in cash to be able to purchase the property, because you'll receive that much.
Are the rates tied to what the market is, like in homes, or is it completely different?
Again, it's kind of like we were talking before. It's a risk-based price. The loan to value, if we're at that 85%, if you get lower, towards 70%, if you're putting in more money, of course that can help improve the rate. Your credit score, whether it's a 620 or if it's a 720, that'll help kind of improve that rate as well. So to say it's tied to a market, it kind of is, because rates go up and down based on fluctuations in the market. But most of that rate, that kind of gives us, he was talking about the margin over prime of where they are. That gives us as a bank, where we're kind of putting our pricing, and then we scale that up and down based on the risk that we're taking on each individual loan.
Mike, just kind of tagging on what you say is through First Community is, like when you were talking about you'll do, say, 80%. Is that 20%, is it anything like HUD requirements to where that 20% can't be borrowed, or?
No, the 20% can be borrowed. It can be another piece of collateral. We would like to see some, as he said earlier, some skin in the game, even if you're putting in, 3, 4, 5% of cash or something, we would love to see that. But, I think depending on, your business plan and kind of how we feel about that, that allows us to make a decision what level of risk we're willing to take there, of what the other 15 to 20% is, is being used and covered by.
I mean, I feel like I'm kind of throwing my money away renting, and I'm not getting any equity at all by giving my landlord all that money to be able to do it.
Sure.
So it seems like something viable, but, it just kind of rolling around.
Well, I mean, your payment history with your landlord, that's even a, that's proof to us that you have the capacity to continue to make that payment, every month. So that's absolutely a factor to bring in wherever you go to.
And the same factors to me, and to some extent, on whether or not to lease or to own. It's the same scenario as if you're doing it on your personal residence. If there's a lot of structural issues with the property, the good thing about that is that, depending upon your lease, that may fall back on your landlord's responsibility and not fall back on you, such as HVAC units. If you've got a pretty big building, you're maybe looking at $10,000 to $20,000 HVAC repair, if you own the building. So, I mean, it's kind of one of them things, if they want sale price of what they feel it'll come in, at market value, what's the condition of the building and those kind of things, but.
And how much responsibility.
Yeah, because then you're factoring in things like property taxes, you're adding, you're taking away from your bottom line too. So and some, a lot of times you can get your payments a whole lot cheaper than your lease too. So.
Yeah.
The reason I was asking about that 20%, that could be one of them situations to where, you're pulling from different entities to get that money. That way, the First Community or Virginia Community Capital, Mount Rogers, don't have all their eggs in the basket. They kind of got partnerships with other locations or other lenders. You might go to Mike and he say, well, we'll do 80%. And as long as your cash flow would allow it with them, and as long as they know these things ahead of time, you may come and borrow that 20% from People Inc. and us look at taking a second lien behind First Community, those kind of things. It's very important to know your options and know what's out there, and try to spread it out, so that one bank or one financial institution isn't taking the full bite of things. I know with us, it looks a whole lot better, you're using different lenders and so forth. That way it's kind of spreading everything out.
Thank you.
Scott, I was going to see about what the interest rate is for the revolving loan, and how do they apply for that? Is that directly through Mount Rogers?
Yes, so that's through Mount Rogers. Generally, when someone wants to begin the loan process, they'll meet with myself and somebody else at the PDC, and kind of we'll go over their application, and if they have a business plan, kind of review that business plan. Believe it, we have a digital copy of the application. We're planning on getting that online, but it's not quite there yet. So then once the application is submitted, we'll call a meeting of the loan committee. The loan committee will review the application, the applicant's personal filing statements, as well as their credit. And from there, that's where we set our interest rate, and it's at the discretion of the committee, so it's kind of similar to the risk-based. And so from there, if the committee can either approve it, reject it, or request more information. And I think from application until closing, generally between 60 and 90 days, possibly longer, depending on if additional information is needed.
Can somebody tell me what the advantages or disadvantages are between a business loan and just if I had the collateral to sign, to go get a personal loan, a signature loan, what would be my advantage to go get a business loan instead of just a straight up signature loan?
First thing that pops in my head is your tax deduction.
Okay, so
for the business.
I know that's the one big thing. Is that
Right.
really primarily what the difference is between the two?
Well, you're developing credit with that business as well, so 5 years from now, if you're ready to expand, you've got the business credit history as well, so.
And typically too, if you're going to a bank and you're getting a business loan, you may be getting a better rate than that. So your monthly payment will possibly be less.
Okay. So it could be less, the rate
Yeah.
itself could be less, in addition to the tax
Sure.
benefits of that, okay.
And your term could be, if it's equipment, you can
Longer.
probably amortize it longer than you could if
Yeah.
you just go say, I'm trying to borrow $5,000 or
Okay.
$10,000. So you get a lower payment.
I'm not a CPA, but I am accounting, and I can tell you that when you start mixing personal money with business money, there's some tax ramifications, with all of that.
Yeah, that's the problem is, and you kind of touched on it there a little bit, my husband works, and I quit, so I don't have a job right now. So really, I'm mixing personal money with business money because he's kind of backing me right now. So I'm not sure, if I just continue to let him be my lender, or if I need to go get money myself, And that's why I was wondering if there's a benefit to going for a business loan, because I'm not really a business yet, you know what I'm saying?
Keep in mind too, that as you're taking away from your personal finances, the personal financial statement that we were talking about a little while ago is shrinking, not in your favor.
Right.
Because you're pulling from your personal finances, investing in the business. Now, it's kind of a catch-22 because now you're having to borrow less money, so you're having to ask for less. But just to give you an example, in a loan committee meeting that we had today, we were just talking specifically about a gentleman that we were looking at for an additional loan. And one of the committee members asked about a personal financial state or a key man insurance because the loan was so large. Didn't we require key man insurance? And the one thing that got this gentleman out of us requiring that key man insurance was because his personal financial statement looked so good. He had a whole lot of property that he could liquidate and pay off his debts, or his wife could, or he could, either one, if either one of them became deceased, or their ability to run the business wasn't there, if you will. It's got its pros and its cons. You're not investing money, you're not borrowing the money, but at the same time, you're taking away from that your personal assets too. So.
Well, in my case, I own the farm just myself. I mean, it's in my name and the equipment that goes with the farm. But my husband and I own the house together, our house that we live in, and the other property, we have other properties, so we are intermixed. It's not, there's no real definite division there. So he would have to co-sign, I would think, if I went to get a business loan. I couldn't do it myself unless I put the farm up, literally. So, it's just kind of complicated. It gets a little tricky, and that's why I'm wondering if I need to take a business loan in my own name and try to keep him out of it.
Are you LLC'd?
Not yet.
Are you doing sole proprietorship right now?
Yes.
Okay.
I can tell you, just by experience, the way I started, I owned the land. And I was pretty much the same boat you was. And I talked to my tax guy, he told me what to do, so that's what I had to do. I did everything he told me, and I haven't had a problem yet. And that's what I suggest, is talk to your tax man on how to keep that. Don't try to do your taxes yourself.
Oh, I
It'll drive
don't.
you crazy.
I don't.
It'll drive you crazy.
Yeah.
And one thing, before I forget it, I sat through this class last year and the year before. This is my third time. I don't know who said it last year, but someone brought it up about these cash is on the way with CashNet USA, these guaranteed cash people. Could y'all touch on that? Because I remember.
Stay away.
Yeah.
Stay away.
Stay away.
This is, People Inc. is real fond of success stories from their clients and so forth, and how we've, helped or been an intricate part in people's involvement in life and business endeavors and so forth. And I've kind of got my own in coming on board with them. I spent 13 and a half years as a district manager with a payday loan company. Now, before anybody throws tomatoes at me or rocks, hang on, I'm self-redeemed now. These individuals, I'm not here to bash any company, but I am here to shoot straight. Those type of companies, I spent 13 years training workers on how to get people to come in and get trapped. That's just what it is. So if you ever heard the old saying that if it's too good to be true, it probably is? Well, I don't know how many loans I've done over the past 5 years with People Inc. that have been these individuals that have went to Cabbage.com, some of these places that Well, guaranteed money from, startup businesses, but you're looking at like 20% interest rates, 26% interest rates. Some of them's ridiculous. Now, that's not to say that they don't have programs that offer low interest rates. I haven't dug that much into it. Speak with your local lenders. Talk with them before you reach out to anything like that. We're here to help you. We're not here to just deny you money. We're here to help you. So talk with us before you get into anything like that. That's dangerous. It's hard to get you out of it once you get in it. I'm glad you brought that up. I didn't get anything thrown at me either. That's good.
I'm retired.
You hadn't got out yet.
Yeah. Nobody waiting to
I'm
park
retired
lot on
military.
me.
I just remember my soldiers would go down to these cash and fancy places before payday, and it was just a snowball effect on them. Once they got up in it, it was hard to get them out of it.
Yeah. And there's regulations on these type of businesses that are coming into play all the time. The CFPB really put a crackdown on those predatory lenders, if you will. They've really cracked down on them. And a lot of banks have chosen to quit doing business with those type of, I know when I was with them, they like to keep national banks involved, such as your BB&Ts and your Bank of Americas, and everybody's just quit doing business with them because it's not a good reputation for a bank to have that kind of relationship with a predatory lender. So if that kind of gives you an outside look in, when a bank won't do business with you, period, they won't even take your depository accounts, probably got problems, So I didn't mean that to turn into a bashing session.
It was covered last year. I just remember, because it kind of struck home at last, because with all the people under me in the military, we always had every year 3 or 4 privates getting into that situation and bouncing checks, and the next thing you know, it's just trouble from day one. First time they do it.
So, and I know I got confused about all this early on when I went into politics, but people incorporated in Mount Rogers Planning District do something separately from, banking and Virginia Community Capital. Can you all kind of help them with that? Like Mount Rogers mostly works in communities like Damascus and Glade, low population. So can you talk about that a little bit?
Mount Rogers PDC is a PDC, Planning District Commission, set up by, I believe it was the Virginia state government. So everywhere in the state of Virginia has a PDC. We primarily work in grant management for localities, housing programs, water programs. The revolving loan fund started, I want to say, the 70s, 80s, through a grant by the Economic Development Authority. And so they granted us money with the condition that we would loan it out. And then in the 90s, we acquired loans from the USDA to kind of do the same thing. And so we're kind of a pseudo or a government agency, but not quite a locality. And so while we do work in grant management, this is kind of another program that we do, that we have in our warehouse, similar to People Inc., where they have a lot of different programs.
Pretty much with Scott and I, the folks we work for, this is your tax money at work. That's ultimately what it comes around to. With the SBA lending that I do, we seek from the SBA an allotted amount of money. We may go and say, hey, we want to apply for $500,000 from the SBA. And they say, like currently, they say, well, the most you can do with any one business with a loan strictly funded with SBA is capped off at $50,000, a term of 6 years. You can't use that SBA money to purchase real estate with. You have to bring some other funding into play. With a bank, and Scott, Mike and Ernie, please help me if I speak out of term here, but when you go for an SBA guarantee loan, the SBA guarantees the money back to the bank, correct? Is that
In a case of default.
right?
We lend our money out and based off of our deposits and things like that we have and the cost of funds, we have to base that with the SBA guarantee. They're the last source of, you do an SBA guarantee and the loan goes bad, we've got to get rid of every bit of the collateral that's left on there, and then their guarantee comes in to take,
The debt.
to take our loss down some.
Yeah.
Which allows us to make loans that we would never make without the guarantee.
Right. And then tagging on to what Ernie had said, with us, what we do is we go to the SBA and say, hey, I would like $500,000. These are our guidelines for what we're going to lend under. They come back with their guidelines that they want us to lend under. And so the money that we're lending you from the SBA comes directly from the SBA in essence. We just administer those funds, if you will. We have to pay those back. It's a loan to People Incorporated. We have to pay a certain percent back to them, which comes out of that 7.5%. So if you're paying at 7.5%, the yield for People Inc. may be 4%. We may be paying 3.5% on that. So that's kind of how, when I said your tax money going into work, the taxes that are used to fund the SBA comes back. And the same with them. In the long run, I mean, the guarantee that the banks get if the loan should default, that's your tax money too, but it's a little bit more direct with us versus the bank being a little bit, they can be a little bit more, understanding in certain areas and try to get you qualified because it's their money primarily that they're using. So it's all got its pros and cons. With me and Scott, we kind of fall into that place after you've been to the bank, like I said earlier, and you don't qualify there. We're just kind of that bridge to get you to that point. Did that answer your question, Sandy?
It did, and
Okay.
I kind of knew, but some of the folks, if you live in a community like Kuwait or Damascus, you can work with Mount Rogers and they'll work with the town, and if you're creating some jobs and you're making some
Right.
capital investments and doing some things that are making those communities more vibrant, then it's worth your time to talk to Mount Rogers about that. And I don't think many people really know or understand much about the workings of how the communities try to help
And-
build business.
And most of those grants that you hear about, they're I'd say 90% of the time, 95% of the time, job-based. How many jobs are you creating? What wages are you paying? I know that Basita can give, forgivable loans over a certain amount of time, but you may have to employ so many individuals at a certain income, and things of that nature. And not saying you have to have a bunch, but depending upon the amount you borrow plus what's forgivable, how many jobs you're creating and what amount you're creating. When you're looking at grant-based lending, you got to think of what is your business contributing to the local economy. And People Inc. with the business lending, I can cover all of Southwest Virginia all the way up to Botetourt County, up past Roanoke, and then we got this large gap in the middle, and then we go up to the northern Piedmont area up in Prince William counties and those areas up in there. So we cover a large, all of Southwest Virginia. And we'll go over into Bristol, over into Sullivan County, and we'll go over some into Mercer County into West Virginia, and those kind of things. So usually when there's like within the county, if there's a fund that they set aside to grow businesses, like for example, Bristol, they have the Downtown Bristol Redevelopment Loan Fund. If the towns don't have the ability to administer loan funds, to make loan decisions and those kind of things, they'll usually hand those loan funds off to People Incorporated to administer because we've got a system set up to administer those funds. So, like in this case, if you were located up and down State Street or West State Street, and they're pretty flexible too. If you're close in proximity of West State Street and State Street, they'll kind of expand out. It's not etched in stone, if you will, but there's funding available specifically for businesses up and down through there that actually local banks within that area have went together and created a loan pool. Some of them may have contributed $5,000, some of them may have contributed $50,000 or $100,000 to that loan pool, but local banks are trying to give back in a way too, to try to help businesses outside of their loan capabilities.
So we're kind of similar in being grant-based lenders. One of the things is we can only fund up to half of a project. That doesn't mean half a business, just half of a particular project or a phase. Kind of if you're going for a $30,000 truck, we can loan up to $15,000. We generally look for about $20,000 per job, and kind of with us receiving money from EDA, we have reporting that we have to send in, but generally, we look for job creation. Another thing kind of talking about tying in with Damascus and Glade, we work with Town of Marion, Abingdon, cities of Bristol, Galax, and so, while we, in addition to our loan program, can also say, well, there's this opportunity going on because of a downtown revitalization, kind of how you were mentioning. And so it's just kind of we're more government-based, kind of economic development rather than traditional lenders.
But both of your programs are revolving loans, so when the funds are used, depleted, you have to wait until.
Some of ours aren't. Like right now, we have funding from Appalachian Community Capital that we've actually borrowed in the form of a loan, and it's not revolving loan funds necessarily. But yeah, Sandy's correct in that. Just like I was talking about the 9th District Development Fund. Once that money's gone out, we have to wait for that money to recirculate back in. And on the 9th District Development Fund, with the amount of money that's out right now, you're probably looking each month, there's probably roughly around $12,000 to $13,000 a month repaid back into that loan fund. Now, some of those have to be kept aside for administrative fees and those kind of things and keep the thing operational, but about $12,000 to $13,000 gets built back up in that fund each month. So, if someone's coming to us for about $50,000 loan, that's why I said you want to keep checking back. Right now, those loan funds in that revolving loan fund account may not be available right now, but in 5 months, we would have $50,000 to lend. So.
That's similar in nature to us, at least with the EDA money. But with USDA, that's part of a loan that we have to pay back. So that pot of money takes a little bit longer to cycle back, but the EDA money does not.
And in any of those anything where we borrowed money from, of course, as our maturity date comes closer, the less likely you're going to be to get a longer term loan, because if our loan matures, say, in 10 years, 2 years from now, we can't be doing a 10-year loan using those funds because our loan matures in 10 years, well, now 8 years. So the feasibility of the longer term shrinks as time goes forward, unless new funds become available.
Mike, you was talking earlier about doing a fleet loan.
Yeah.
Did that business, did they come in there and they do like 5 or 6 different car loans with you, or did they
No, we
do
do.
a lump sum?
We do one loan. It was 7 vehicles. We financed, I think we did 5 years, 100% financing. I think actually the rate on this one was 3.95% fixed for 7 years, or for 5 years, sorry.
And did they turn over the car titles to you though?
Yes, yeah. We actually place the lien. You actually don't even turn over the car titles. Everything's done electronically through the DMV now. Yeah.
That's a good rate.
Yeah.
You can't get that on your personal. It's tough to get that on a personal.
Now that, again, there's risk-based pricing. This business, actually, this business was a startup here in Washington County about 4 years ago, and I've been with them since the beginning. And very similar to you all, they started out, it was just an idea, and we had some tough years in the first couple years of they provide a service, and they bill out that service, and they get paid, sometimes 30 days, sometimes 60, sometimes 90. And so we did what's the ABL line, asset-based line, and we secured it by receivables. They had a $150,000 line starting out. Some months they had $50,000 available on that line. Some months they had $150,000. So it basically, as their business grew, we grew the line. Now they're in a $300,000 line of credit. Their financials, we were talking earlier about a 1.20 cash flow coverage. They were a 4.65 cash flow coverage as we looked at their financials for this. And this is a matter of 4 years they've went to that.
Yeah.
So it's, there's definitely, kind of going back to the question about rate, that 3.95 was, a risk base. They've kind of moved to that, moved over that hump, and their business is really doing well now. Probably 3 years ago, that rate would have probably been 6%.
Just to give First Community Bank a plug, they are one of the Pitch Awards and they also are one of the sponsors of this whole deal.
I'm gonna ask a basic question. I'm not sure what a revolving loan is.
So that's when the money loaned out gets paid back and then is able to be loaned out again.
Okay.
So if we give you a loan for $100,000 at 3% interest rate, once that gets paid back fully, we'll take that interest rate if we have to pay back a loan to pay back our expenses and then relend that $100,000 out.
So pretty much that money stays in circulation.
It's like your credit card.
Yeah, for personal level. it's
That's what
like
I
your
thought,
credit
but I
card.
just wanted to be sure I was understanding.
The goal is that that fund keeps growing.
You had a question?
I was just curious, the taxes and bank, you know, I'm sure you have to bring bank statements and stuff like that to what you bring. I will be in business by myself. How does my husband play into that? Being on my taxes, being involved in everything.
So that's the reason, from First Community Bank standpoint, that's the reason we request W-2s.
Okay.
So we can kind of factor in how much he provides to that, you know, line one on your tax return, which is your gross income, or your W-2 wages, I'm sorry, how much he makes up of that W-2 wages, that factors in. You know, you have the option of, if your spouse guarantees, then we factor in all of that income. If he guarantees the loan with you, if you want to do that alone, what we would require are your W-2s, your tax returns, and then a personal financial statement that only has your assets. So if you own a home together, then, and it's worth $100,000, then probably on your personal financial statement, it needs to say it's worth $50,000. Likewise with the debt, though, if it's a $100,000 home, you have, you know, $80,000 of debt on it, you know, you only have to take credit for about $40,000 of the debt.
What if my name's not on
If your name's what?
it? Not on any.
I mean, whatever assets you have, if you're doing the loan by yourself, that would be whatever goes on the personal financial statement. Yeah.
With us, it's a little different in a sense that if say an individual comes in and they're a co-borrower on, say, a mortgage, something like that, depending upon your debt to income and how that falls, because that debt has been consumed by two individuals, there's a good chance that it's going to take that individual's income to help justify all the debt that is associated. A lot of times, you know, people say, well, you know, let's put you on the house just in case. Sometimes that can cause more problems than it can help. When you put them on the loan, it doesn't necessarily, that's how the deeds wrote up. You know, it doesn't happen often, but you can have someone's name on a deed and them not necessarily be liable for the loan too. But if you're liable for the loan and you're put on there, then chances are the financial institution, and particularly when you come to us, if you're a co-borrower on a loan, we're going to assume that you have full responsibility of that loan. So it changes with lender to lender. Some of them are easier, some of them are tougher. It can be looked at in several different ways.
Any other questions?
Did you bring your checkbook?
We have bags of money outside.
That's the benefit of going to mine. With me, I've got to put everything in and request a check. They don't even give it to me.
I've got a crazy question because I've just read about it. Yes, I love Google. I've seen the term in kind as repayment. And I mean, I've Googled that, but what is that as far as?
In grant management, in-kind matches, let's say the grant is to build a road. If the town happened to have bags of asphalt that they were going to put down on the road, then they could use that as kind of an in-kind match. It's basically a match that isn't cash. Now, I know that you can do in-kind matches for grants, but I've never heard of it for a loan. And I can't imagine that it would be particularly beneficial to a lender.
That's the first
I know
time I've
you
even heard of
two
it.
actually work with grants and stuff.
And that's the first time I've even heard of
You
it.
hadn't
So
heard of it. I knew they didn't do any kind, but you two work with grants.
Yeah.
And I've kind of read that in the grant area.
Right, yeah, and so just, really just kind of depends on the grant, but yeah, I don't think you do that with a loan at all.
When looking at applying for a loan, how much time should you give yourself before you say you need the money?
I think it changes with each financial institution's going to have their different levels of approvals, I guess it needs to go to. I mean, you know, you can go to any one particular bank maybe, and I know this just from, you know, borrowing money myself, is that some lenders have limits that they can borrow, I mean, that lend at bank. Is that the way it is at First Community? You know, and sometimes it depends upon the tenure of an individual. I've you know, seen individuals at Highlands Union back then. I went into a particular branch one time, and that particular person, because they were brand new, had to have someone get approval there. So it took a little bit more time. Then again, you know, if you are within the allotted amount of them individuals, you may get a decision right then and there. With People Inc., we have a couple different steps that it would go through. If it's 10,000 or under, that stays between myself and a director. We'll make that loan decision. That's just something that just recently got put into play. If it's a 30,000 down to 10,000 and a penny, it'll still stay in-house, but it goes to the director and I, and then it goes before a committee. That committee's in-house, so it can be relatively quick once we get all the information, you know, turnaround time. If it's greater than 30,000, that has to go to an external committee, which are individuals who do not work directly for People Incorporated. Instead, they're just volunteer for a board to look at that. So then you're at the mercy of being able to have a quorum for the meeting and calling everybody together. If someone was to come to me and the loan was under 30,000, I'd say 2 to 3 weeks. If someone was greater than 30,000, you're probably looking anywhere between 30 to 60 days, depending upon how quick the wheels turn. NDDF is a little longer. It could take up to 4 to 6 months, because you can imagine, just being tourism based, that committee isn't going to meet very often. So they try to call a meeting once we have a loan application in play, but where they don't meet that often, it's kind of hard to get everybody together at once. And respectfully so, if you're volunteering for a board, you know, or a committee. So.
Is it the same kind with banks as well?
Not really. Up to 125,000. You know, you come in, bring your business plan in, you and I talk through it. You know, we're basing a lot of that decision on your personal credit score and things like that. So it truly takes me about 15 minutes up to 125,000.
Okay.
Once I've understood your
Sure.
business plan and everything, from 125,000 up to 750,000, about 48 hours. Once I've understood your business plan and been able to, what we put together is a credit memo. So a little shorter timeline, but maybe not as much other stuff can factor in as especially the 125,000 and less. That's purely based on your personal credit score and collateral. And once you get over that, you know, we're bringing in the business cash flow and things of that nature.
They don't trust me with that much money.
Well, look who you work for.
And we meet anything up to $1.5 million. We meet every Monday morning to discuss those with our risk officers. So once you get us everything we need, we normally, takes roughly 3 to 5 days to put it in a package to get it presented to. So if you got everything to me this week, it wouldn't go to next Monday's, it'd probably be the one after. And then anything over $1.5 million, our board meets once a month to review those.
And as far as getting money dispersed too, you're at the mercy. If you use real estate with us, once that loan gets approved, you've got all the legal work and title work and all those kind of things that goes into play. And depending upon how busy your attorney that you choose is, it could be a week's turnaround. I just talked with an attorney the other day on a project that he said, hey, I know this guy, I did a lot of work for him, I know this property, I can get you a week turnaround. And then sometimes an attorney gets busy, especially if they've been in court and so forth like that. I've seen it take as long as 3 weeks, you know, to get a turnaround. It just depends on the attorney that you pick and their schedule.
Yeah, and I would say on the real estate too, I mean, depending on how we value the real estate, you know, in addition to your purchase contract for buying the real estate, we have to value it with an in-house evaluation at the bank that our appraisal department would do, or a third-party appraisal, which can sometimes take up to 30 to 45 days, depending on what type of property is. I will say, you know, like going back to the loan we were talking about earlier with the vehicles, that's a very quick process. As you know, I think the gentleman I was working with, he talked to the dealership on Friday, and we closed it today, and of course, banks were closed yesterday, so it was, very quick turnaround, ultimately get bill sale, and that's all you need to kind of get going there.
And with the PDC, we kind of work similar to People Inc., where we have to call a committee. So generally, I think 60 to 90 days. Just depends on the loan amount, and also depends on whether or not we're going to need some kind of additional information.
What about on the other end, floors, as far as the smallest amount that you would consider for a business loan?
Out there,
Just for
it's
out of curiosity.
500.
500,
Yeah,
just
but
something,
now-
a micro loan, I guess.
Yeah, and we've done as low as 500, and then so far the biggest project I've been a part of is about 750,000, something like that. But we go as low as 500.
What about you guys?
10,000 for us.
We're normally around 200,000 actually.
We're between 5,000 and 150,000.
I like that because we got the all spectrum
Yeah.
covered.
Yeah.
So I got that.
On the asset-based loan, are contracts for services not yet rendered usable in that approval?
Yeah, so in the case of the customer I was talking about earlier, that is not your services typically are, basically for services you've rendered ahead of, or that's coming up, we don't typically count those in. So it's more of a, it applies more of a, you provided the service, you built it out, and that bill will be coming in whatever term that you've set with that client.
Even with, not necessarily just an individual, but like an entity or a government agency or institution, that still wouldn't meet the requirement?
For the future, so what you're saying is, are you saying you have a contract with someone?
I have a contract with an institution, yes, and I'm saying that it's for the upcoming year, but the services have not begun. Is that gonna be something I can bring and say, hey, here's my contract that I've got with these people to try to use that to secure?
Well, based on how they pay you, we would look at that and probably break that into monthly, how that looks at from a monthly basis.
Okay.
And then, in your borrowing-based certificate, which is basically a summary of your financials and everything, you would break that out. Let's say you have a, $120,000 contract, $10,000 a month. Well, we wouldn't let you count $120,000 in month one. We would let you count 10,000.
Okay.
No other questions?
No, going once, going twice. Money, money, money.
Oh, the tag's off, it's over.
Okay.
Point being, come see us. We got money to lend. It's here. You just gotta come with it.
Good luck next week.
Yeah.
Yeah.
Thank you all.
Thank you.
for having us.
Thank you very much.
Thank you.